Internal controls represent one of the most important parts of any audit. They are management's mechanisms to ensure fair and accurate financial reporting. The audit of these internal controls represents a significant audit challenge, one auditors have struggled to meet in recent years. According to the PCAOB, auditors routinely fail to gather sufficient appropriate evidence to support their conclusions about internal controls. We're going to spend a few minutes discussing what are internal controls, how do auditors evaluate them, and ultimately what they report to stakeholders. Internal controls are mechanisms by management designed to serve three purposes. They could be designed to prevent problems from occurring. They could be designed to detect problems that have occurred, or they could be designed to correct problems that have occurred. So, for example, having fire retardant material used in construction prevents fires. Having a smoke detector will detect when a problem has occurred. Having a sprinkler system will correct when a problem has occurred. Ultimately, correction requires detection. And so we see those two are oftentimes connected, and preventing or deterring is a different type of mechanism management may employ. When we think about controls effectiveness, we generally are speaking about two different concepts. Design, which deals with, on paper, could this control achieve its purpose? Operation with, is it applied, i.e. is the design put into place and is it executed? So something can be put in place but not executed. So we have a design, execution, application. And so what I mean by that is, for example, we could design a lock which in theory could keep a door working. We need to install the lock, and we also need to use the lock. That would be an effective physical control. But if it's not designed properly, like for example, if the door unlocks from both sides without a key, that's not a well-designed lock. If it's not actually installed, then it's not effective. And if it's not properly used, it will not be effective. When we think about the purpose of controls, they can actually take on many purposes beyond just accurate financial reporting. They could involve safeguarding assets, timeliness of reporting, efficient business operation, prevention of fraud or non-compliance. Some of these will fall within the scope of the audit, others will not. For example, efficient business operations and timely business reporting are important, but not necessarily necessary to financial reporting. Prevention of fraud is definitely an audit issue. Safeguarding of assets is oftentimes part of it because it deals with the misallocation of assets, which can lead to the client saying items exist when in fact they're no longer physically present at the companies. Examples of controls you'll see, there's a list here. My expectation is that you would not necessarily memorize this list of controls, but you would have an understanding of what each control does if prompted. So if I say management requires 2 approvers for a check, you would understand why that is and what it's hoping to achieve. What does segregation of duties do? Physical controls, account reconciliation such as bank reconciliation or cash reconciliation. Do you know why this is done? What are the problems it would detect? So spend some time reviewing those. Now, when I say a control is well designed, it's going to mean a whole multitude of things. It's going to relate to an assertion. If it doesn't relate to an assertion, it's probably not a non-related problem. If it's not, it's going to address material issues. If it's not going to address material issues, it's not really relevant. Cost benefit, the control is purposeful, meaning there's significant benefits to it. It's well designed, it's consistent, it's maintained, it generates reliable data, and it's testable. The reason why I say testable is important is the auditor can't actually evaluate whether the control works, and they can't rely upon it. And so that's a key criteria. So from an audit perspective, the 3 that would stand out most to me are assertions, material, and testable. Data reliability is also important because if the system doesn't generate good data, it's unlikely we would test it. Now, when I say control environment, I'm obviously referring to the COSO 5-factor framework that we've talked about in both the cost class and in AIS and in prior classes. This relates to the tone at the top, mechanisms within the organization. Generally, attitude is a very hard thing to assess. So we'll look at the actions, the policies, and the procedures. We'll look at how the audit committee operates, the presence of an independent board, code of ethics, what happens when there are rule violations. So we're going to take this very immeasurable thing and we're going to try and measure it. Normally we can't draw comfort from the control environment and say the environment is so good problems can't occur. But we can say this environment does look unstable or has a bad tone at the top, and therefore we have heightened concerns. We talk about risk assessment. That's a management mechanism designed to identify where problems can occur. This is a critical control in understanding what could happen. And so there are basically 3 stages in every transaction that we want to look to risk assessment and ask the question, what could go wrong? We think about how the transaction is initiated. What are the controls in place to ensure that only legitimate transactions are initiated? Then we think about how that transaction is processed and ultimately what is reported. At each of those 3 stages, we should be asking a question, what could go wrong? And assessing that and developing risk lists that contain the possible problems that could occur. When we talk about control activities, we're basically talking about a number of things, from segregation of duties, that is separating the custody, authorization, and recording of the assets. What we're trying to do is make it so no one individual is in a position to perpetrate and conceal a fraud. And so if a person is able to both perpetrate and conceal a transaction, then we are in trouble. Authorization, documentation, physical controls, and independent checks are also examples, but the one you normally think of when I say a control activity is segregation of duties. We'll see authorization emerge with checks, with transactions, with contracts, documentation. Reliability is going to be a big issue there. Who has access to items? Physical controls are less common in today's day and ages. The most valuable assets are normally kept electronically, and independent checks is usually a type of authorization, but it's usually a redundant authorization to verify. Information and communication. Is the correct data captured at each stage in the transaction process? And is that information or data properly transmitted along to the next stage? If we don't have effective information and communication, the underlying controls cannot work. So some general rules we need to know. As a company gets larger, we're going to expect the controls to increase, to become more formal, and to become more complex. Small companies can get away with very basic controls, very limited controls. But as you grow, you need more controls. Now, we need to recognize there are some limitations of controls. One, controls cannot be designed around collusion. Think about an organization with properly designed will have appropriate segregation of duties. But if 2 individuals are colluding, that segregation of duties is no longer meaningful. It won't stop a person who goes above and beyond the authority they've been given. So if we give someone the authority to do something, but they go beyond that, authorized transactions they're not authorized to. Intimidate people or pressure people into doing things they're not authorized to do. That will lead into problems. We also cannot design a system that cannot cope with management override. Now, I'm not saying every management override is a problem. For example, if you ever go into a retail store and you buy something and there's a price error, you want management override in the system. What we need is a check and balance there. If there is a management override, is someone monitoring that to make sure it isn't abuse? And errors, the system actually fails. That no system is perfect. Computers make errors, humans make error, code make error. So how do we address those? Now, we've talked about controls, but as we think about the controls, we need to recognize they're not all logistically possible. The client is in the business of making money, not running controls. So there are going to be some controls that, while theoretically good, from a financial reporting perspective are good, would be so cumbersome they would actually undermine the business. There would be some that would be so costly it wouldn't make sense for the client. They have to they have to make a profit. And so the other constraint is not all controls are going to be effective or consistent. And so we need to decide that, is it worth testing or exploring? So We'd also look at what are the compensating controls. So given that there are these potential fail limitations, given there are these constraints, what can we do? Job rotation is a great compensating control because if there is collusion, if there is someone abusing their authority, periodically rotating jobs, especially around vacations, gives us a lot of information. We'll oftentimes see that as a fraud factor if a person refuses to take vacation. We'll see a person with a lot of turnover in a position will create concern about whether they have the competence to do the job. But on the opposite hand, a person who stayed an unusual length of time in a position would also draw a concern about why they're not being promoted or moved up. And so we see all these complexities. External reviews are incredibly valuable. Supervised reviews are also valuable. So the auditor's responsibility for controls is to, for most of the time, with a private company, they will just be evaluating the controls. And if you review the procedure section, you'll see we have very specific procedures on how we would test controls. But the auditor sometimes is called to issue an opinion on the controls. And this would be section 404 of the Sarbanes-Oxley Act. And so now a lot of private companies voluntarily comply with section 404 because they're trying to signal to the public that they meet the standard. You'll also see some companies voluntarily comply because they're trying to attract capital. And so this will be where the auditor comes in, accepts responsibility for evaluating, or management will accept responsibility for the controls, evaluate controls with a criteria. Currently, there is only one suitable criteria, the COSO framework. Management will provide suitable evidence and the written assessment themselves. The auditor will likewise go through and do a similar evaluation where they will evaluate with the COSO framework, gather sufficient appropriate audit evidence, and provide a written assessment. This is the framework they use. And so essentially, insignificant deficiencies, or sometimes called control deficiencies, is this outer edge of the diagram. So less than remote means that where that line goes up, anything that's remote, we would say is an insignificant deficiency. More than remote, we would classify as reasonably possible or probable. But we have two new lines. Rather than just material and immaterial, we say inconsequential and material. And so if we say something has a more than remote possibility of happening and it's more than inconsequential, is a significant deficiency. But if that significance rises to a material, we would say it's a material weakness. Now, note, all material weaknesses are examples of significant deficiencies, but not all significant deficiencies are material weaknesses. Further, it's possible within a company, they may not have a single material weakness, they might have several problems with controls, each more than inconsequential themselves, but not material, but collectively they're material, in which case we would say there's a material weakness. This classification framework is very important. Material weaknesses must be disclosed to the public. Significant deficiencies only need to be disclosed to the audit committee. Control deficiencies or insignificant deficiencies only need to be disclosed to management. And so, now what does this relate to? Well, significant deficiencies never need to be made public. However, by telling the audit committee, we're hoping the company can internally correct. Now, if a company could, in theory, have repeatedly violated significant deficiencies year after year, however, uncorrected significant deficiencies could be viewed as a lack of commitment to internal controls. A lack of commitment to internal controls is in and of itself a significant deficiency, which may warrant modifying our assessment of the prior significant deficiency to a material weakness. So we see how things are complicated very quickly. But the main point is, the auditor's job is to assess internal controls for public companies above a certain size. When the auditor assesses these issuers, they will go through and they evaluate whether the internal controls prevent material problems. They'll look at how likely the problem is to occur and the magnitude of the problem. If it's more than inconsequential, but less than material, we would say that's a significant deficiency, and we'll communicate that to the audit committee. If it's more than material and more than remote possibility of happening, we would say that's a material weakness. It is possible that multiple significant deficiencies would warrant a material weakness that is disclosed to the public, but that is a judgment decision. Internal controls represent a challenge. I encourage you to go and review the procedures section to learn more about the specific mechanisms an auditor can use to gather evidence related to this. But the main perspective from this unit is what are internal controls and how do you report them?